There we go. All right. Well, folks, thanks for joining us today. Today is a day that we're going to talk about a very sensitive topic, and that's tax deductions. We also are going to incorporate strategies. And the lovely individual that is going to be bringing us that information is Julia Nikishna from New Age Financial Consulting. She's going to give us some insights to help implement in your design firms, hopefully, surrounding tax deductions, of course, and strategies. Just in case some of you are new, which I know we've been signing up a lot of new accounts lately, so that's great. So if this is your first webinar, Julia is has her own company that does bookkeeping and accounting support, including CFO services for both large and small businesses. Definitely specializing in unique and complex accounting needs of your interior design firms and showrooms alike. She also offers a comprehensive procurement service for designers and showrooms. I did it. I got all of that out in one take without like botching it like I normally do. I'm super stoked on that. And before we jump into the content today, one quick house cleaning item. We do QA in these webinars. We want to hear from you. We want to uh, essentially harvest all of your questions for more than just answering them, but to be able to provide support and answers to those questions for the community at large. So sharing and participating is always encouraged and appreciated. So if you have a question, click that little button that says QA in your Zoom toolbar. Might look a little different because I know has done some updates a little lately, so I should probably update my slide here. But in any event, that'll pop up the QA window. Type your question in there. That way we will be able to get to it by the end of the webinar, get you the answers that you need, or direct you where to get the answer if we can't answer that on the webinar. So with that being said, Julia, welcome and thank you so much as usual for doing this for us.
Hi, how are you?
I'm doing well. How about you?
I am doing fantastic. Sorry, I'm trying to open up all my windows and then share my screen.
All good.
So
Let's reason.
to reiterate, yes, so live Q&A. So everyone on your Zoom bar, wherever you are, wherever you have your Zoom bar located, click on that Q&A box and feel free to ask the questions in real time. Hold on. Okay, Anthony, just confirm that you see my correct screen. Studio is up.
Sorry, I'm muted and I'm talking to you over here. Yeah,
Oh,
it's up. Studio's up. We are good to go.
okay, perfect. So we have studio open. So today's topic, I think, is going to be a little bit different from our normal studio how-to, though we obviously do a lot of those as well. And we're really going to be talking about ways and ideas of maximizing your tax deductions. So one of the first things you should be doing as the end of the year is approaching, and we're beginning to do it with our clients, is go to reports. And then go to legacy. We talked about this, I think, 2 weeks ago, the difference between legacy and financial. I'm an old studio desktop user, so I'm just always programmed to go to legacy. I actually like the layout of these reports. I think some of the newer users are going to financial forms, but someone asked it, what the differences are. So really layout and probably muscle memory. So in legacy, right, as the end of the year is approaching, you should be focusing on several key reports, which I'm sure we'll talk about in webinars down the road. But to understand where you are for net income, you would be looking at your income statement and then also keeping tabs on your balance sheet. So go to your income statement, click on the first one, 01, that's my favorite. You'll automatically be filtered to this current year, and then the period from and period to is January to whatever period you're looking at. So if you'd like to just concentrate on everything through Q3, so that's September here, or obviously October through today, I voice this to Anthony all the time. Include zeros should be a company preference. I never want to look at zeros. They are not my favorite. I don't like them. So I always exclude them here because I feel like it clutters the report. And so when I PDF, I mean, we could go through this granular, and remember, this is a test database, so it's super fun. But it looks like we have very little administrative expenses with that, which actually for today's topic could be a good thing. And so here's our net profit, right? So we're showing that we have $1 million in profit. Now, remember, studio designer is accrual based. So that's only, excuse me, that's recognizing revenue and expenses for product that's invoiced. So if we have additional money in client deposit, which we can look at, that's not going to populate on this particular report. And so our net income right now is about $1 million. And so if you're looking at your administrative expenses, right, this is what you should be reviewing monthly, quarterly, and then of course annually. But you want to be able to say to yourself, okay, am I maximizing the deductions that are listed here? So I could tell very quickly from this report. And again, I mean, honestly, keep in mind, test database, but our travel expenses, for example, are $29. That's obviously grossly understated. And we have lots of room for improvement on that. My question to you, if this was your firm and you were a client, would be, okay, well, are you accidentally using your personal credit card instead of your business credit card to capture all of your travel and meals? If you also notice, there's actually no meals expense at all on this particular income statement. Keep in mind, meals now in 2023 are only 50% deductible, whereas the couple of years during COVID and after COVID, they're actually 100% deductible, which was unusual. So now the IRS reverted it back. So if you haven't been good about for this year, let's just say, right, you haven't been good about putting travel expenses on your business credit card and meals expenses on your business credit card, we could still capture that expense, and there's lots of ways to do that. And so hopefully you're working with an accounting or a tax professional who can instruct you on the easiest and the best way to capture that and put it into your income statement. And if you have been doing it on your personal card, I mean, we can, look at those and we can adjust it. And you can, a lot of the credit cards are easy in terms of if you go to CitiCard, for example, and pull your annual spending report, I want to say, like it'll actually total it for you. So it'll say, here's your meals, here's your travel. Keep in mind, when we're talking about tax deductions, well, they're only, I don't want to say they're only as good as your comfort level, but they're they do have to do with your comfort level, right? I mean, some of us are more comfortable to be aggressive in terms of expenses, some of us aren't. Some of us are very by the books, some of us aren't. So our clients do come to us and we do strategize in terms of comfort level, and a lot of our comfort level depends on this number down here. So if I put $50,000 worth of travel on my personal credit card, but I made no money this year, this didn't show $1 million, I wouldn't add back $50,000 worth of travel. I wouldn't do that, right? My comfort level doesn't. If somebody came to me and said, well, they want to do that and they want me to file that number for them, I would actually really urge them to say, you know what, I'm really not comfortable. You're not, we're not overly profitable this year. Let's reevaluate that. Or let's take a step back. Let's see where you got that number. Same with, for example, meals. And so I pick on meals and travel because they're an easy number or an easy way to pick up a tax deduction that can be difficult to audit. So also comfort level, if there's an audit, what do you do? And so when we have clients that ask us the question of, well, can I write that off? My answer is, okay, great question. Are you comfortable? If it's a questionable write-off, right? Are you comfortable substantiating that if the IRS auditor is sitting right next to you? I've mentioned this now a couple times throughout the year. I mean, audits are back. They were on a lovely hold for about 3 years or so. And so we got, we still are, but our first audit after COVID came back in Q4 of last year now. And so they're, allegedly going to be picking up. I mean, right, the IRS was supposed to be adding agents. So that is usually a really good question just to ask yourself, right? Oh, if I'm writing this off through the business, if the auditor was sitting next to me, can I substantiate it? What paperwork do I have? And what's my comfort level? And everybody there, I would say not necessarily a right or a wrong. I mean, in some cases, there definitely will be a wrong, but a lot of times it's just, how you want to manage the business and what are you looking for down here, right? So again, if we're at $100,000 net profit, this is a different conversation than if our net profit's $1 million and we're trying to reduce that number. If I go back to our administrative expenses, so we talked about travel, we talked about meals, they're missing here. Okay, why? Let's just assume they're on our personal card. So you're the client, and so I think we're in Roberts. Are we in Robertstone? Oh, maybe they renamed us. For the longest time, this was Anthony. They must have renamed it. It makes me really sad. We were always in Robertstone Consulting.
Yeah, I don't know
But
what.
now, okay, so this
Details.
is so it says studio designer. So we're not in studio designer, but we're in studio, ABC firm. And so we pulled up the administrative expenses. I'm noticing you don't have any telephone expenses. Okay. Why? Where, excuse me, all of us nowadays have a cell phone. Where is that cell phone being paid? I would treat it in a similar way to travel and meals. If you haven't been running that payment directly through the business, we can capture it, right? We can adjust it to say, oh, okay, I forgot, I've been paying it personally. I want to add it into this grouping. I'm going to account for it. And let's say it's $300 a month in the last 10 months, and that's $3,000. So we'll add that in here. So we'll pick up the deduction, which is great, but we'll also proactively change how we're making that payment to one of the carriers moving forward. So we'll change it into the business account and we'll be able to pick that expense up in real time. So that's obviously can be a small number. And the next question a lot of times that comes up with cell phone plans are plans, right? So what do you do if you have a business plan and not only do you have employees on there, but you potentially have family members on there as well? So that's another great answer, like the travel and meals, and that goes back to comfort level, and everybody's going to react and treat that situation a little bit differently. So ask yourself again, well, if the auditor was sitting next to me, what would my response be? Somebody's asking a great question. Yes. Would you ever expense half of it and keep the other half personal? Yes, you could. I mean, I really would say in that kind of situation, there really isn't a right or a wrong. Percentages work really well. So percentages work really well in a lot of these different cases. So let's use the $300 a month bill, but it's for, I don't know, 5 of you. Does that sound reasonable? And 3 of you are related to, or 4 of you are related to the business. 1 of you isn't. I would absolutely then expense, 80% of that cell phone bill, because right, 4 into 5 is 80, and keep 20% of it personal. Then think about the actual accounting, like how does that get paid? I mean, hopefully none of us are mailing checks into our cell phone providers anymore. Hopefully all of that is set up on auto pay. And so then it becomes an adjustment in the GL. And whether you're picking up 80, whether you're picking up 100. And remember too, I mean, you really can sort of decide that, I would say, as you go. I mean, consistency, I think, is really key, but you could also make that a decision at the end of the year to say, oh, you know what? I was actually super profitable. I am comfortable expensing the whole thing. I'm going to keep that in my telephone number down here. Or, oh, shoot, I wasn't as profitable as I thought I would be. How about I move 20% of the bill into my owner's distribution or my owner's draw? So those are all definitely, I think, proactive approaches and ways to pick up on a bill like that, right? That can potentially be personal and business. Another one is auto, right? That's a big one, and that's actually usually a big conversation throughout the year and with different clients, right? What do? You own a business. You obviously have a car because it needs to take you from place to place. Do you lease or do you buy? That is, again, a bigger conversation. Interest rates play a role. we're back and forth with a client at the moment to say, okay, well, what's a better situation in terms of rates? Should we lease or should we own? If you purchase and you decide to keep the purchase in your personal name, that's usually a better rate than putting a purchase, right, a loan into the business name. That will give you typically a higher rate. If you lease, it's an easier tax deduction than if you purchase. However, if you lease similar to your cell phone, the conversation will be, okay, well, how much of the lease is used for personal versus business? A lot of times, in case of an audit, the question, auto expenses do get scrutinized for sure, especially I think in our industry where luxury automobiles are the norm. The question will be, if you lease a vehicle, lease now, not purchase, if you lease a vehicle and you run the entire lease as a deduction here, someone will ask you, someone being the auditor, but you will be asked, okay, well, if you're expensing the entire lease, do you have another personal vehicle that can get you from place to place? If your answer is yes, this up here in terms of a deduction is a much easier argument than if you don't. So keep that in mind again when you're talking or when you're thinking through what your auto expense should be. If you're deciding to purchase, so when you're also leasing too, you can leasing in the name of the business is, I would say, usually fairly easy. You're still going to PG, personally guarantee it anyway. So the dealerships, I think, are very used to that standard. And I haven't found much of a difference with lease rates when it comes to automobile. When it comes to purchasing, again, there usually is a difference. And then when it comes to purchasing, you're going to be faced with a similar question, personal business, but then the way you're deducting it is just a bit more complicated, and it does have to do with depreciation. And it does have to, and it does have to do with how much actually the vehicle weighs. So if the vehicle weighs over 6,000 pounds, you're able to pick up a higher depreciation. If it weighs less, you're not. So hopefully, again, you're working with somebody who can assist you and run some of these scenarios for you. And then you can make that determination. A lot of times too, we even ask the question with clients who have a lot of cash, depending on the interest rate, what's a better use of our dollars? To hold on to the money and earn money market rates on a large purchase, or to use the money in a savings or any type of holding account and buy something in full if we can afford it, right? Again, that's an entire calculation based on rates as well. So remember too, rates just dropped. So if you're in the market for a car, those are all good things to consider. When you're doing the car analysis, right, something else that comes up is gas, right? So fuel for the car, I would say that's a relatively easy expense to pick up. Automobile insurance lives in that gray area, such as your telephone, right? So a little bit harder to make the determination. A lot of times too, automobile policies are bundled, right? They're bundled with your homeowners, they're bundled with your spouse. And again, I would say that makes it trickier. Sometimes if an expense, like in my opinion, is really small, we're not necessarily adding it if it needs to be split. I'll just keep it on the personal side. If my car insurance is, I don't know, $500 a year, I actually don't know if that even sounds reasonable these days for car insurance. But there's also 3 cars on there because my child has one, my spouse has one. Am I looking to figure that out and add it into here? I may not, right? As opposed to if I'm paying $1,000 for a car and that winds up being $12,000 a year, right? That's a really worthwhile exercise for me to have. So as you could tell, our auto expense here is very very low, and we don't have any fuel. I don't know what this $29 is. We're also never using the tax database for anything having to do with our administrative expenses. So that's why, well, we went crazy with office supplies. A lot of clients ask us about Amazon, where they're buying things for the business through their Amazon account, and they're also buying things for your home. I always say just be careful, right? It goes back to, it's gray. What's your comfort level? So if you buy pencils, I'm a pencil person. So if you buy pencils for your home is someone going to know that you didn't use them at the office? The answer to that is no. But if you're buying, I don't know, protein powder, I was just trying to find some on Amazon, but they were out. If you're buying protein powder, that's clearly not related to the business, right? So even though it's in the same Amazon account, I would say do your part. And make sure that you have a business credit card linked there. Make sure you have a personal credit card linked there. Part of the other, I think, aspect of having accurate expenses down here is, and it will depend on the size of the firm, right? But we do need to understand what are our true business expenses, and then what are our, I've used this term before with clients, like what are our business deductions light? So they're deductible, but maybe they're not necessarily a direct cost of the business. They're just like a perk. And there's creative ways to structure that. You could have secondary credit cards, etc. But we don't want to be too sort of I don't want to say inconsistent, but too random in here, because then we really have no idea, well, how profitable were we, or were our expenses too high, as an example. So it's a fine balance. Retirement contributions, again, none listed here, but depending on if you have a staff, and we'll talk about staff compensation next, but 401k and IRA, if that's not something you have set up for yourself, and your entity structure will depend on that as well. If you don't have that set up, you have some time. I mean, plans do need to be set up by end of the year. You don't necessarily need to contribute by end of the year, but you definitely need to make sure that the plan is set up by end of the year to be eligible. So 401k, I would say, is the more likely option if you have staff. There is an IRS administrative credit. I believe it's for 3 years, and it's for new plans that are set up. So that's a great, it's a great perk for staff. It's also tax deductible, and you do have flexibility. It will depend on who your plan is set up through, depending on like the number of plan, I don't want to say benefits, but the number of plan variances you could have in your plan document. But it's tax deductible, so that's always a positive. It's a benefit to you if you have a match, and it really is a great benefit to staff. From the 401k plan is more expensive from an administrative cost, but you could also set up if it's just you and you're an S corporation, or if it's just you and you're an LLC, setting up a SEP IRA is a great option if you have the cash to make a contribution for yourself that will deduct this number down. It'll decrease your net income down here, which is great. And so in terms of whether it be, especially a SEP actually, so as long as you have the SEP set up by end of the year, you have the ability to contribute to it up until the time you file your return. So if you're a timely filer of 315 or 415, you have to make that contribution then. If you're on extension, you have until 915 or 1015. Remember too, whoever you're working with on the general ledger side in studio, they do need to make that that adjustment, and they'll make that through journal entries to make sure that you pick that up. Somebody's asking about a solo 401k plan. I would say you can, they're just they're typically expensive. Like, right, when somebody's looking at it to say, which one do I open? A lot of times a 401k plan is actually not favorable because of those administrative costs, and because of the upkeep, right? You're required to file a 5500. The 5500 audits the plan to make sure you're in compliance, as opposed to an IRA doesn't have the same requirements, so it's just cheaper to maintain. And once you start having staff, the 401k really does become the better option, and the cost of the plan is, I mean, a cost of doing business, but then again, also remember, there is that 3-year tax credit at the moment as well. So those are, and if an IRA, or well, if a retirement has been on your radar, but you haven't done anything with it, honestly, a lot of times, despite, I mean, a 401k plan is, you're probably almost even too late unless somebody could expedite it. I would say they're like 60 to 90 days to set up, as opposed to, an IRA should be a lot quicker. So again, keep both of those things in mind. You will need to know what your net income is, in terms of contribution levels. So as long as your general ledger is up to date, you'll be able to make that determination. And then remember, from a cash standpoint, it is great. You can tell, I'm going to use Studio, right? You could tell Studio Designer, you could tell the system, okay, I have this deduction, but it's not going to be paid out until, X date closer to the tax filing. If you do have staff, and so our expenses here don't reflect that at all, but if you do have staff, your benefit structure can be set up in a way that obviously benefits you and benefits the staff. I think some additional expenses or some additional structures to think about, right, is bonusing the staff come end of the year. So again, if this number is high and you are cash heavy or cash positive, it's a great way to incentivize the staff. It's also a great way to reduce your net income and increase your expenses. Hopefully, if you have medical benefits for the staff too, you're working either with the staff or with your broker in terms of contribution levels, right? So what are you paying for? What are they paying for? And then what about some expenses such as, are you adding staff to your cell phone plan? Are you reimbursing them? How do you treat both of those situations? Because again, they help the employee and they also help you from the total expense standpoint and the net income standpoint. If bonuses are new to you, and you know that that they're on the table this year, end of the year bonuses, obviously very common. I mean, we have firms that are doing quarterly bonuses, more so last year than this year. Last year and the year before, I think they were really common just because of the sheer amount of revenue going through so many of the design firms. But it is, again, just a really great thing to evaluate come as I don't know how many days out from the end of the year, but I do know, we calculated Christmas the other day. We were 66 days out over the weekend. So probably 66 from the end of the year, if you're talking through 12/31. So it'll be here before you know it, really. When you're thinking about benefit packages, employee development, or like any type of professional development, that's usually a big one as well. So that's something to consider. And you could even set it up as a GL item in here to say, okay, well, every employee gets $500 as a self-improvement credit. That is tax deductible. You can make it $1,000. I mean, you could make it a crazy number. But if you add it to your general ledger, easy way to track year over year over year. And again, just a really great benefit to them. We've spent a lot of time talking about expenses down here, but remember, because Studio is accrual, which in my opinion is super fantastic and actually super, I want to say user-friendly, but super helpful, maybe would be the term. Be very mindful, especially now, again, let's say we're 60 days out, what you're doing in terms of revenue recognition. So we started talking about this a little bit. Remember, this number is based off of, invoiced product. This number is based off of time. And this number is based off of the cost of invoiced product. But now that it's end of the year, right, proactively, start looking at, I like this form better. So start looking at your client deposit if you're not looking at it throughout the year. Okay, so I filtered off zeros, no. And I'm going into this report to say, okay, well, I'm showing $1 million profitable, but how does that relate to the rest of the dollars that I've already received in Studio? And so just as a refresher, this report's amazing. It's a classic. It's been around since the original inception of Studio Designer, and it's really letting us know at a glance where we are with client funds. So the first column is, as its title, the total number received from funds available. So this particular client up here is my test client, the one that I know I always play around. So Tom Hanks and Rita Wilson have paid us $1.14 million. Out of that 1.14, my next column has to do with proposal deposits. Now, this is where revenue recognition becomes critical. We have $53,000 on proposals, but what does that mean? That means in studio, on my items, if I go to 19th Street. Okay, it's thinking, oh, there it goes. If I go to 19th Street. Oh, it's thinking again. Well, it's okay. I was gonna say it's gonna get to 19th Street eventually. So if I go to 19th Street and I look at all of my items that are not invoiced, that's what the proposal deposits reflect. So like an easy way to look at that is to go to your item screen, go to item list. This is one of my favorite ways to look at it. And then I actually throw everything with, and you can also do it in reports too. So I'm going to throw everything with an invoice to the bottom. I can't tell if it refreshed or not. Because if I throw everything with an invoice to the bottom, I'm now able to see all of my items that are not invoiced at the top. And so if those items, if I go back to item detail, if those items have a payment, okay, it'll catch up. So if those items have a payment on it, or like right here, oh, that's invoiced. Oh, maybe it didn't keep my filters. Okay, hold on. I usually click around faster than it likes to think. So in my item list, if I throw all of my items to the bottom, oh, yeah. I want to throw all of my invoiced items to the bottom. So I only want to see my items that aren't invoiced at the top. If I then revert this back to item detail, it'll show me items that are not on an invoice, and then I'll be able to see if those items have payments on them. If they do, so I'm waiting for this to catch up, like this one. So this item is actually not even on a proposal, which is really, really poor practice. So this particular item here, this $4,300 is living in this $53,000 proposal deposit. This client paid, they put money on a proposal, it's on an item, and it has yet to be invoiced. So we only invoiced $328,000. So as the end of the year is approaching, oh look, we also have Bill and Hillary Clinton, though they are not as exciting as 19th Street. We're going to ask ourselves if the $53,000 needs to be invoiced or can be invoiced, or if we want to defer it. So I would say comfort level does play a role, but also just your process, right? Like, when do you recognize revenue? When do you review project reports? And when do you review client deposit? So if you don't necessarily have a set revenue recognition process, and this is new to you, and you're super profitable in this report and this number down here, you may say to yourself, oh, okay, I don't have a great revenue recognition process. I am comfortable deferring revenue into the previous year, into the following year. And so if you decide to defer, and this is like this number here is a small number, right? But actually a lot of, well, like here's 186,000. And we know that Franklin Street, as an example, has been completed, and it was completed in, May. It's been completed for months, and the senior designer that was working on Franklin Street left. And so we didn't realize that there was so much money in proposal deposits, meaning we didn't pick up revenue. So we didn't pick up here. We didn't pick up any income sales related to items. We didn't pick up cost of sales here. And all of this money sort of is living in flux, right? It's living on your balance sheet. If you're an accrual-based filer, so that's part of this question and or analysis as well. If you're an accrual-based filer, this is helpful. If you're a cash-based filer, this is not helpful. And again, conversation with your tax preparer. So if you're an accrual-based filer, you're going to say to yourself, well, I'm $1 million profitable. Am I comfortable deferring this 186,000 to next year. So at the moment, it is showing as not recognized, right? So you're already doing that, but the proper thing to do, because this project was installed months ago, is to invoice all of it. And you would pick up revenue and cost of sales, and then obviously the profit would flow down to your net income. That's a question for yourself. Again, it's also just a great reminder of process, right? Like, how do you manage that at the office? The next bucket, especially when we're related to Franklin Street, and it's even worse with our friends at 19th Street, is this funds available bucket. So what does this bucket mean? So this is any money clients have given to you that's basically living in their, well, in their funds available account, which is similar to like a retainer account, but people use the word retainer, I would say, in different ways, meaning a retainer can be a true retainer where you could apply it to things down the road or items or time billing. A retainer could be returnable, meaning you hold on to it and then return it when a project is complete. A retainer could live there and you could wind up keeping it. So the funds available bucket, first of all, is a great function of the software, but it is used differently by firms. So if we're in this Franklin Street example and we realize that the designer left, we didn't recognize 186,000, but shoot, we also have $122,000 in funds available. Okay, well, what do we do? So if you initially started this conversation to say, well, I want to see how profitable I am, and I want to get a proactive approach for the year, but then you go to client deposit report and you notice you have projects in there that need to be cleaned up. Start by going to your 2010 report and filter by Franklin Street. Go to your PDF. And this would be the place for you to clean up items this would be the place for you to clean up items. So like I have $122,000 in funds available, but I also noticed that this client owes me $662. I noticed they owe me $203. I noticed that there's a whole bunch of stuff not invoiced on here, but we were talking about that. This item looks like it could go away. So great steps to implement would be to start by cleaning up the 2010 or the project, any type of project worksheet that you're used to first. Then apply the remainder of your money out of funds available here to clean up any open balances. Perhaps they received this Parker dining table, but it wasn't invoiced and you forgot. Perhaps there was no PO because it was an inventory and wasn't treated correctly. You're going to know the ins and outs of that. I am not. If I go down to the bottom, this report is showing the client owes us $431,000. Quite a bit with time billing. We owe vendor balances, but this would be a great first step. Clean up as much as you can, and then the conversation for you or for the team would be, well, for the maybe even reference your contract. What do I do with this 122? Do I give it back to the client? Do I keep it as revenue? Everyone does it differently. That's always my answer.
It sounds like it's a multifaceted report and that it really helps one organize whose kneecaps need to be broken in the event that money is owed.
That is I need to remember that. You should email me that so I could use that on client calls.
I will definitely email that to you.
I mean, it is. I mean, it's so much of this is always like, oh, wait, well, there's no right or wrong, right? Everybody's different and your comfort level is different. And how aggressive do you want to be? I mean, if this was our studio, right? Like if this was our firm, first of all, we're doing a really poor job with accounting. There's that. But if this was our firm, are we really comfortable keeping 2.5 million in client deposit as deferred revenue? There's no black and white answer for that, right? Everybody's answer really, truly will be different. This 2010 report, for any of you who have joined me in the past, you know that this is my all-time favorite. If you learn any report, it's this report because it's so useful and has so many filterable options. But going back to our client deposit, and we saw for, I don't know what, Franklin Street. We saw, what number was that? 165, 160 something? Oh, 186. So 186 in proposal deposits. But if you say to me, well, I don't know what that is. The person managing it left and I have no idea. So go into your 2010 report and add a couple filters. and put in client payment. So client payment is not blank. And then put in invoice is blank. And then hopefully this will be an easy way, and it's only 3 pages now as opposed to 8, for you to see, oh, shoot, here's my $186,000 that they have already paid me. What do I do with it now? Am I recognizing it because this is all product and an incorrectly entered purchasing fee as an item versus through time billing, but that's okay. Are you going to potentially maybe recognize some of this versus all of it? Because you don't want to pick up all the revenue, but you know that you should be picking up some. So the 2010 report is incredibly versatile, and it should be able to extrapolate so many of those answers, but again, with the right filters. So like, if you say to me, you know what, I don't want to product, I'm okay to not recognize, like, it's okay, we're gonna leave it there. But something like this, like if it were me, I would urge you, or I would, strongly suggest on a call to say, Mr. and Mrs. Client, this purchasing fee, that really isn't work in progress, right? That's true earned revenue, and it was earned immediately, and we didn't really treat it correctly, right? We entered it as an item, and we really should be entering everything related to time through time billing. So let's invoice that. And granted, this is $20,000 of income, meaning top line income, and time billing will live at the top, and there's no offsetting cost of sales, right? It's just time. So it'll live here, hopefully, if it's mapped correctly. And then it'll increase here too. So it'll be sort of like a straight increase to this bottom line number. But because it wasn't entered correctly, it would just be like that. That would be my recommendation. So those are, I think, some higher level suggestions. We talked a little bit about expenses, I think, that are gray. Another expense that I think, get questioned a lot on are things like country club dues. Can they be expensed? Can they not? That answer, like so many, is, well, it depends. You can, again, don't be egregious with it by any means. And a lot of times with those country club dues, right, you have the actual dues, and then you have the meal credit that you need to keep up every quarter. And honestly, are you going there as a family to eat, or are you only taking clients? That always goes into that conversation as well. Insurance policies, we didn't touch upon necessarily. And again, the test database isn't a good indicator. But make sure that you have general liability, look into cybersecurity, errors and omissions, and workers' comp. So that should be listed in your administrative expenses here. Potentially short and long-term disability, though keep in mind those are expensive. Life insurance is a common question. Can I expense my life insurance? I would say typically not. And there's actually pretty strict guidelines about who the beneficiaries are, and if you're a solo proprietor, you would not be expensing life insurance at all. If you have staff, it really just depends. So I think that, again, that wraps up most of our bigger tax deductions. Let me know if you have questions in the Q&A box. Anthony, do you have any questions?
I don't, however, I do feel like I want to go start my own design business today, because it sounds like there's quite a bit of perks that I might be missing out on not having my own business.
Well, yes, I mean, that's definitely true. I mean, yes, I mean, you're taking on the expense of the business, and in theory, right, you're paying taxes on a smaller number, right, because you're running administrative expenses through. But I mean, I'm sure right, pros and cons to both. Unpredicted revenue is a con.
Yeah, definitely.
Oh, Tria asked a great question. So Keyman Insurance, I mean, yes, I would actually say we're not seeing a ton of those types of policies. And beneficiary would probably play a role in terms of deductible and not deductible as well. Where do you see the purchasing fee and what is a WIP report? So I'm not sure what a purchasing fee is. I don't know if we're referring to a procurement fee. So a WIP report is a report that captures any item on a purchase order that's not on an invoice. So though I do use a WIP report at the end of a project, again, personally, it is not my go-to in terms of project management. This report here is my go-to. Can you expense a car leased under your name versus the business name? So great question. You can be mindful. And are you renting? Are you leasing a $2,500 Mercedes, or are you leasing an $800, probably at this point, a Toyota? You definitely, the answer is you can. And then from there it goes into, well, it depends. I don't see any dues and subscriptions on your income statement. Confirm, yes. So dues and subscriptions, or again, I'm sorry, remember, I should really just spend some time and import a bunch of administrative expenses, because I come across this all the time where I pull the income statement and I'm like, I'm so sorry, we have no business deductions. I actually really recommend setting up software versus dues and subscriptions. I like to see software as a number, especially in our industry. It can be a really big number. So I like to see that fluctuation up and down. But yes, Studio Designer is deductible. It's a great question. Any other questions before we sign off? Hopefully everybody found it insightful. Oh, let's see. Mileage and gas. So I'm going to say again, the answer is yes. But because there's so many ways you could structure automobile expenses, it is a bigger conversation. How do you lease? Do you purchase? Do you have another vehicle, personal versus business? If you're purchasing, what are you utilizing section 179, et cetera. So black and white answer is yes. Secondary answer is lots to explore on that front.
Well, awesome. Oh, we got another one. Are there any different report reviews for cash basis tax?
Oh, so that's a really great question. However, Studio is only accrual. So you are going to actually have a very, I wouldn't say difficult time, but it is a secondary, and in my personal opinion, unnecessary step to convert to cash. So really the approach should be, why am I filing cash? I really shouldn't be in this space. Let me reach out to my tax preparer to understand. Also, you can convert, but there may be implications one way or the other, positive and or negative. And it makes sense to convert in a year when it helps you from a tax standpoint instead of hurting you. But so the income statement in Studio is only accrual, and it should stay that way.
All right. Mary Beth says, does Studio have an accrual to cash calculation report?
Same answer as above. No, it does not, and it should stay that way. That question needs to be flipped to, why am I filing on cash? I'm in an accrual-based business. Any other questions before we wrap up?
It looks like that's it. But I would love to be able to yield 10 minutes of worthy time back to everybody. If everybody has had their questions answered, as usual, thank you so much for joining us today. We really appreciate your attendance and coming to these sessions that we put on. And if you need to reach out to Julia for any reason, Julia@newagefinancialconsulting.com is her email. There's her phone number and her website as well. And if you need to reach out to Studio support, obviously help@studiodesigner.com is how you can create a ticket for yourself that we can address. but we highly recommend using our chat assistant as it is powered by Chat GPT, which basically means that it scans our whole entire knowledge base and provides you with solid answers. Worst case, if it doesn't give you what you want, you can always request additional help and it'll create a case for you. On top of that, two things. You can talk to this like you would talk to a person. It doesn't have to be robotic or keywords or whatever. You can legitimately ask it a question. It's like an actual AI bot. So it's super, super helpful. And also, if you could, as a favor, to help us keep everything streamlined and our level of communication or um, our for lack of a better term, quickness of response time. Make sure that you're labeling give it a thumbs up if it was helpful, and if it wasn't, give it a thumbs down. That way we can figure out where we need to tweak the information to make sure that you're getting exactly what you need quickly and efficiently. Outside of that, I hope you all have a wonderful day. Julia, as always, thank you for all the valuable content you bring to our community. And with that being said, I wish you all a good day, and we'll see
Thank
you next
you.
time.
Okay, I'll talk to you soon.
All right, see you, Julia.
All right, bye.